Every morning across the United States, millions of investors wake up and check their phones before they even leave their beds. They open their investment apps, refresh their portfolios, and silently hope to see green numbers instead of red. For decades, this simple habit came with a strong sense of confidence. The U.S. stock market had built a reputation as one of the most reliable wealth-building systems in history. People believed that if they invested consistently, stayed patient, and trusted the system, their wealth would grow over time. Retirement accounts expanded, portfolios recovered from downturns, and long-term investors were rewarded for their discipline. It felt like the market followed rules that everyone understood. But today, something unusual is happening beneath the surface of U.S. markets. It's not loud, it's not dramatic. It doesn't always appear in breaking news headlines. Instead, it's a slow and steady transformation, a silent shift that many investors haven't fully noticed yet. And what makes this shift so important is that it isn't about one company, one sector, or even one economic event. It's about the structure of the market itself quietly evolving in ways that could reshape how Americans build wealth in the future. To understand this shift, we first have to look at how markets behaved in the past. Years ago, the U.S. stock market was driven by a wide range of industries. Manufacturing companies powered economic growth, energy firms supplied the nation's needs, financial institutions supported lending and development, and technology companies introduced innovation at a steady pace. The strength of the market came from its balance. If one sector struggled, another often picked up the momentum. This balance created stability and made the system feel resilient. Investors didn't rely on just a few companies. They relied on an entire ecosystem of businesses working together. Today, however, that balance is beginning to change. A growing portion of market gains is now being driven by a relatively small number of massive corporations. These companies are not just large. They are dominant on a scale that previous generations rarely experience. Their products reach billions of people. Their services shape daily life, and their financial strength allows them to expand faster than competitors. As these companies grow larger, their influence over the broader market grows as well. This creates a situation where the performance of just a few major companies can determine the direction of entire market indexes. On the surface, many investors still believe they are well diversified. They invest in index funds that track large portions of the market, assuming their money is spread evenly across hundreds of companies. But the reality is more complex. As the largest companies continue to expand, they occupy a bigger share of these indexes. This means that even diversified portfolios may be more concentrated than investors realize. It's a hidden form of risk, one that doesn't look dangerous until market conditions begin to shift. At the same time, another powerful force has been reshaping the market: passive investing. Over the past 2 decades, passive investment strategies have become extremely popular across the United States. Millions of Americans shifted their retirement savings into low-cost index funds, attracted by simplicity and lower fees. Instead of trying to predict which companies would outperform, investors were encouraged to own the entire market. This approach made investing accessible to everyday people and removed many of the barriers that once limited participation. However, passive investing created an unexpected side effect. When money flows into index funds, those funds automatically buy shares of the largest companies in the index. They do this regardless of whether those companies are undervalued, overvalued, or facing new risks. As more investors choose passive strategies, more money flows into the same group of large companies. This creates a cycle where the biggest companies receive more capital simply because they are already big. Over time, this feedback loop strengthens their dominance and increases market concentration. While these structural changes were unfolding, another transformation was taking place. Interest rates began to rise after years of remaining historically low. For more than a decade following the financial crisis of 2008, borrowing money was inexpensive. Companies took advantage of low rates to expand operations, hire workers, and invest in new technologies. Investors became comfortable with risk because cheap financing made growth easier to achieve. But as inflation increased in recent years, interest rates began to climb. Suddenly, borrowing became more expensive, and financial decisions required greater caution. This shift in interest rates changed the way investors evaluate companies. In the past, many investors focused heavily on future potential. Companies with ambitious growth plans received strong support, even if profits were years away. But in a higher rate environment, expectations began to shift. Investors started paying closer attention to earnings, cash flow, and financial discipline. Businesses that once relied on cheap debt found themselves under pressure to prove their stability. This transition marked a subtle but meaningful change in market priorities. At the same time, technological innovation introduced yet another layer of transformation. The rapid development of artificial intelligence created excitement across industries and fueled massive investment into companies building advanced computing systems and digital infrastructure. The promise of AI sparked optimism about the future of productivity, automation, and economic growth. Investors rushed to support businesses that appeared positioned to benefit from this revolution. As expectations grew, valuations followed, pushing certain sectors to record levels. History shows that technological revolutions often begin with intense enthusiasm. When new technologies emerge, they attract attention, capital, and belief in a better future. But history also shows that expectations can sometimes rise faster than reality. Markets have experienced periods in the past where innovation led to rapid growth, followed by sudden corrections. This doesn't mean progress stops, but it does mean that markets occasionally pause to reset expectations. Recognizing this pattern helps investors remain realistic during periods of rapid change. Perhaps the most overlooked shift of all involves investor behavior itself. The tools available to investors today are faster and more powerful than ever before. With mobile apps, commission-free trading, and instant market data, individuals can react to news within seconds. Social media spreads information at lightning speed, influencing sentiment and encouraging rapid decision-making. This level of connectivity has made investing more accessible, but it has also introduced new forms of volatility. When millions of investors respond simultaneously to headlines or trends, price movements can become more unpredictable. As these changes continue to unfold, a larger picture begins to take shape. The U.S. market is not collapsing, and it is not losing its strength. Instead, it is evolving into something more complex than before. The foundation remains strong, but the structure above it is shifting. Concentration among large companies is increasing. Passive investing continues to dominate capital flows. Interest rates are redefining financial discipline. Technological breakthroughs are shaping future industries, and investor behavior is becoming faster and more reactive. For the average investor, this silent shift carries an important lesson. The strategies that worked in the past may still work, but understanding how the environment is changing has become more important than ever. Diversification remains valuable, but knowing where risk is concentrated matters just as much. Patience continues to be a powerful tool, but awareness is what allows investors to adapt when conditions evolve. Looking ahead, the next decade of U.S. markets may not look identical to the last. Leadership among sectors may change, new industries may rise, and old assumptions may be tested. Investors who stay informed, remain disciplined, and avoid emotional decisions are more likely to navigate this transformation successfully. The goal is not to predict every movement, but to understand the forces shaping the broader landscape. Because in the world of investing, the most significant changes rarely arrive with loud warnings. They don't always crash through headlines or trigger immediate panic. Instead, they build slowly over time, hidden beneath daily fluctuations and short-term noise. And by the time everyone recognizes the shift, the market has already moved into a new phase. That is the silent shift happening in U.S. markets today. Not a sudden collapse, not a dramatic crisis, but a gradual transformation that is reshaping the way wealth is built across America. The investors who recognize it early will not necessarily panic, but they will prepare. They will pay attention to structure, not just price. They will focus on understanding, not reacting. Because the future of investing doesn't belong to those who move the fastest. It belongs to those who see the changes others overlook and act before the shift becomes obvious to everyone else.